Imagine you are the lead auditor, responsible for auditing a company's current liabilities during the planning phase. You identify several potential risks and challenges related to current liability auditing. Describe 3 specific audit procedures you would implement to respond to these risks effectively. Explain how each procedure addresses a different aspect of auditing current liabilities and how it contributes to the overall audit quality. Perform analytical procedures. Although analytical methods are a crucial part of any audit, they are particularly crucial when evaluating current liabilities due to the volume and volatility of these accounts. Comparing financial statement data to anticipated outcomes based on the industry, past performance, and other pertinent data is a key component of analytical techniques. Example: an auditor may assess how the company's current accounts payable balance compares to that of the previous year and to the balances other companies in the same industry, an indication that the company is not paying its suppliers on time. Could be found if the auditor notices a notable increase in the current accounts payable balance without a matching rise in sales or other operating expenditures. How it addresses a different aspect of auditing current liabilities. Auditors can evaluate the overall reasonableness of the company's current liabilities and spot anomalous swings in current obligation balances with the aid of analytical tools. How it contributes to the overall audit quality. Analytical techniques lessen the possibility that auditors would miss important inaccuracies in current liability accounts. Confirm accounts payable and other current liabilities directly with creditors. Another crucial audit process is the direct confirmation of current liabilities, such as accounts payable, with creditors. Direct confirmation entails requesting confirmation from each creditor regarding the amount and maturity date of the company's outstanding debt. Example: an auditor would typically send a direct confirmation request to each of the company's top 20 accounts payable vendors. The confirmation request would ask the vendor to verify the following information: the amount of the company's outstanding balance, the due date of the balance, any other relevant information, such as any discounts or rebates that the company is eligible for. How it addresses a different aspect of auditing current liabilities. Independent verification of the existence and completeness of current liabilities, such as accounts payable, is given to auditors through direct confirmation with creditors. How it contributes to the overall audit quality. Direct confirmation with creditors of accounts payable and other current liabilities lowers the possibility that auditors will miss material misstatements in these accounts. Test the company's internal controls over current liabilities. The company's internal controls over current liabilities should also be examined by auditors. The company has internal controls in place to prevent and identify errors and irregularities in its financial reporting. Example: an auditor might test the company's internal controls over accounts payable by observing the following: the process for approving and paying invoices, the process for reconciling the accounts payable ledger to the bank statement, the process for reviewing and investigating unusual fluctuations in accounts payable balances. How it addresses a different aspect of auditing current liabilities. Testing the company's internal controls over current liabilities helps auditors to assess the risk of material misstatements in these accounts. How it contributes to the overall audit quality. Assessing the internal controls of the company concerning current liabilities aids in lowering the possibility that auditors will miss material misstatements in these accounts. Conclusion: these 3 procedures are just a few examples of how auditors can efficiently audit current liabilities. The particular protocols that are suitable will change based on the industry, size, and risk profile of the organization. All auditors should, nevertheless, Carefully weigh the dangers and difficulties involved in auditing current liabilities and adjust their audit protocols accordingly. Question 2. Illustrate the comprehensive flow of completing the audit process and audit procedures for a typical financial statement audit engagement. In your response, provide a step-by-step overview of the audit process, starting from the initial planning phase through to issuing the final audit report. Describe the key audit procedures, objectives, and considerations at each stage. Ensure that your explanation covers all significant aspects of the audit process and procedures to demonstrate a deep understanding of the audit cycle. Audit process for trade payable. Step 1. Vouching trade payable account is the process of verifying the accuracy and completeness of the account payable ledger. This is done by reviewing the supporting documentation for each payable, such as invoices, purchase orders, and receiving reports. Objectives of vouching trade payable account: to ensure that all trade payables are valid and supported by documentation, to identify and correct any errors in the trade payable account, to prevent fraud and ensure the accuracy of the financial statements. Key procedures in vouching trade payable account. Select a sample of trade payables for vouching. The sample should be representative of the different types of trade payables and the different vendors that the company does business with. Obtain the supporting documentation. This documentation may include invoices, purchase orders, receiving reports, and contracts. Compare the supporting documentation to the trade payable record to ensure that the information matches. This includes the vendor name, invoice number, date, description of goods or services, quantity, price, and total amount. Investigate any discrepancies that are found. This may involve contacting the vendor, reviewing the company's records, or performing other procedures. Make any necessary adjustments to the trade payable account. Document the findings of the vouching process. Considerations for vouching trade payable account. The size and complexity of the company's trade payable account will determine the extent of the vouching procedures that are necessary. The risk of fraud and errors in the trade payable account should also be considered when determining the extent of the vouching procedures. The cost of vouching the trade payable account should be weighed against the benefits of preventing fraud and errors. Example of key procedures in vouching trade payable account. Vendor invoice. Verify that the vendor invoice is accurate and complete. This includes checking the vendor's name and address, invoice number and date, description of goods or services, quantity, price, and total amount. Purchase order. Compare the purchase order to the vendor invoice to ensure that the information matches. This includes the vendor's name and address, description of goods or services, quantity, price, and total amount. Receiving report. Compare the receiving report to the vendor invoice to ensure that the information matches. This includes the vendor's name and address, description of goods or services, quantity, price, and total amount. Step 2. Tracing selected samples for trade payable is a procedure that involves following the flow of transactions from the point of origination to the point of recording in the accounts payable ledger. Objective of tracing selected sample: to verify the accuracy and completeness of the data in a selected sample of records. Key procedures in tracing selected sample. Select a sample of records to be traced. The sample should be representative of the different types of records in the system and the different departments or individuals who are involved in processing the data. Identify the source of the data for each record. This may involve reviewing the system's documentation or interviewing the individuals who are involved in processing the data. Follow the flow of data through the system, verifying that each step in the process is performed correctly. This may involve reviewing additional documentation, interviewing personnel, or performing other procedures, make any necessary corrections to the data. Document the findings of the tracing process. Considerations for tracing selected sample. The size and complexity of the system will determine the extent of the tracing procedures that are necessary. The risk of errors in the system should also be considered when determining the extent of the tracing procedures. The cost of tracing selected sample should be weighed against the benefits of preventing errors. Example of key procedures in tracing selected sample. Order fulfillment. Trace an order from the time it is placed by the customer to the time it is shipped. Verify that the order is accurately entered into the system, that the inventory is picked and packed correctly, and that the order is shipped to the correct customer. Invoice processing. Trace an invoice from the time it is received from the vendor to the time it is paid. Verify that the invoice is accurately entered into the system, that the goods or services were received and accepted, and that the invoice is paid within the agreed-upon terms. Step 3. A test transaction is a simulated business transaction that is used to test the internal controls over a particular business process. Objective of testing transaction for trade payable: to verify that the transactions are valid, accurate, and complete. Key procedures for testing transaction for trade payable. Select a sample of trade payable transactions to be tested. The sample should be representative of the different types of trade payable transactions and the different vendors that the company does business with. Obtain the supporting documentation for each transaction. This documentation may include invoices, purchase orders, receiving reports, and contracts. Compare the supporting documentation to the trade payable transaction record to ensure that the information matches. This includes the vendor name, invoice number and date, description of goods or services, quantity, price, and total amount. Investigate any discrepancies that are found. This may involve contacting the vendor, reviewing the company's records, or performing other procedures. Make any necessary adjustments to the trade payable account. Document the findings of the testing process. Considerations for testing transaction for trade payable. The size and complexity of the company's trade payable account will determine the extent of the testing procedures that are necessary. The risk of fraud and errors in the trade payable account should also be considered when determining the extent of the testing procedures. The cost of testing the trade payable account should be weighed against the benefits of preventing fraud and errors. Example of key procedures for testing transaction for trade payable. Verify that the invoice is from a legitimate vendor. This can be done by checking the vendor's contact information and website. Compare the invoice to the purchase order to ensure that the information matches. This includes the vendor's name and address, description of goods or services, quantity, price, and total amount. Verify that the goods or services were received and accepted. This can be done by reviewing the receiving report and obtaining approval from the appropriate personnel. Verify that the invoice is accurate and complete. This includes checking the vendor's name and address, invoice number and date, description of goods or services, quantity, price, and total amount. Step for recalculation is an audit procedure that involves the auditor independently performing calculations that were originally performed by the entity. Objective of recalculating: to ensure that the trade payable account is accurate and up to date. Key procedures for recalculation for trade payablist. All unpaid trade payables. This can be done by obtaining a report from the accounting system. For each trade payable, obtain the supporting documentation. This documentation may include invoices, purchase orders, receiving reports, and contracts. Recalculate the balance of the trade payable account based on the supporting documentation. This includes verifying the quantity, price, and total amount of each trade payable. Investigate any discrepancies that are found. This may involve contacting the vendor, reviewing the company's records, or performing other procedures. Make any necessary adjustments to the trade payable account. Document the findings of the recalculation process. Considerations for recalculation for trade payable. The frequency of the recalculation process will depend on the size and complexity of the company's trade payable account and the risk of errors in the account. The recalculation process should be performed by a qualified individual who is independent of the accounts payable department. The recalculation process should be documented to provide evidence that the trade payable account is accurate and up to date. Example of key procedures for recalculation for trade payable. Calculate the balance of the trade payable account by adding up the balances of all unpaid trade payables. Compare the balance of the trade payable account to the balance in the general ledger if there is a discrepancy. Investigate the cause and make any necessary adjustments to the trade payable account. Document the findings of the recalculation process. This documentation should include the date of the recalculation, the name of the individual who performed the recalculation, and any adjustments that were made to the trade payable account. Step 5. The review audit procedure is a type of audit that provides limited assurance that the financial statements are free from material misstatements. The review audit procedure is less extensive than a standard audit, but it still involves some testing of the financial statements and the company's internal controls. Objective of reviewing: to provide limited assurance that the financial statements are fairly presented in accordance with generally accepted accounting principles (GAAP). Key procedures for reviewing for trade payable: inquiry of management to obtain an understanding of the company's business, its internal controls, and the financial statements. Analytical procedures to compare financial information to prior periods and to industry benchmarks. Testing of selected transactions to verify that they are properly recorded and accounted for. Testing of selected internal controls over financial reporting. Overall review of the financial statements to ensure that they are presented fairly in accordance with GAAP. Considerations for reviewing for trade payable. The extent of the review audit procedures will vary depending on the size and complexity of the company, as well as the risk of material misstatements. The auditor should also consider the company's internal controls when designing the audit. Procedures. Example of key procedures for review audit. Review the company's accounts payable process and test a sample of trade payables to verify that they are valid and supported by documentation. Review the company's financial statements and ensure that they are presented fairly in accordance with GAAP. Question 3. In a detailed and organized manner, categorize and explain the types of audit reports that are appropriate for various audit opinions. Consider different scenarios where the auditor's opinion may vary, such as unqualified opinions, qualified opinions, adverse opinions, and disclaimers of opinion. Provide clear examples and explanations for each type of report, highlighting the key components and language that distinguish them. Your response should demonstrate a thorough understanding of the relationship between audit opinions and the corresponding audit reports. Qualified opinion. The auditor was unable to obtain sufficient evidence to support certain assertions in the financial statements. The auditor has concerns about the company's internal controls over financial reporting. The company has used accounting principles that are not generally accepted. The company has a material uncertainty that casts significant doubt on its ability to continue as a going concern. Example: qualified opinion. Scenario of qualified opinion: transparency, reliable, true and fair view, compliance with ESA. 1. Reliable. The auditor's qualified opinion indicates that the financial statements are reliable and trustworthy. But there is one matter that users should be aware of. Users should carefully read the Basis for Qualified Opinion section to understand the matter and its potential impact. 2. True and fair view. The auditor's qualified opinion indicates that the financial statements are true and fair. This means that the auditor believes that the financial statements are true and fair overall, but the matter in question could have a material impact on the group's financial position. Basis for Qualified Opinion 1. Classification and recording. The auditor has also stated that the lack of clarity on the classification and recording of these items has affected the comparability of the current year's figures and the corresponding figures. This means that users of the financial statements should be careful when comparing the current year's financial performance to the previous year's financial performance. Unqualified opinion. The auditor obtained sufficient appropriate audit evidence to support all of the assertions made in the financial statements. The auditor believes that the accounting policies used by Avillion Berhad are appropriate and have been consistently applied. The auditor believes that the financial statements are prepared in accordance with IFRS, and the requirements of the Companies Act 2016 in Malaysia. Example of unqualified audit report. Fairness of the financial statements. It states that the auditor believes that the financial statements fairly present the company's financial position, performance, and cash flows in accordance with IFRS, and the requirements of the Companies Act 2016 in Malaysia. Compliance with ISA. Auditor complies with the ISA 700 by law and other relevant standards in issuing the unqualified opinion. We conducted our audit in accordance with approved standards on auditing in Malaysia and international standards on auditing. Reliable. The auditor indicates that the financial statements are reliable and trustworthy, gathered enough evidence to support the unqualified audit opinion. We believe that the audit evidence we have obtained is sufficient and appropriate to provide a basis for our opinion. Disclaimer opinion. Auditor is unable to form an opinion on whether or not the financial statements of a company are fairly presented in accordance with generally accepted accounting principles (GAAP). Situation used for disclaimer opinion. The auditor is unable to confirm certain receivables with customers. The auditor is unable to assess the valuation of certain assets, such as inventory or goodwill. The company has used a new accounting principle that is not yet widely accepted by the accounting profession. The company has a significant amount of debt and is facing financial difficulties. Example report of disclaimer opinion. Example report of disclaimer opinion. Basis of disclaimer opinion. Because of the significance of the matters described in the basis for disclaimer of opinion section of our report, we do not express an opinion on the accompanying financial statements of the group and of the company. This sentence is the auditor's disclaimer of opinion. It states that the auditor is unable to form an opinion on whether or not the financial statements are fairly presented in accordance with GAAP. Reason for audit disclaimer opinion. We are unable to form an opinion on the financial statements due to the potential interaction of the uncertainties and their possible cumulative effects on the financial statements. The auditor is concerned that the uncertainties that are facing AirAsia X Berhad may have a significant impact on the company's financial statements, and that the uncertainties may interact with each other, which could further amplify their impact. Adverse opinion. The auditor has identified material misstatements in the financial statements, and the company has not corrected the misstatements. The auditor has significant concerns about the company's internal controls and believes that the controls are not effective in preventing or detecting material misstatements The auditor has concerns about the company's management and believes that management is not acting in the best interests. Example report of adverse opinion. Example report of adverse opinion. Basis for adverse opinion. The auditor has identified a number of significant matters that have led to the adverse opinion. Here are some of the implications of an adverse audit opinion. Investors and lenders may be less willing to provide funding to the company. The company may have difficulty obtaining insurance or other financial services. The company's stock price may decline significantly. The company may be subject to increased regulatory scrutiny.